Great. Well, Neil, welcome to the blockchain.com podcast. Your latest book, Doom, we have here. You went in depth looking at historical catastrophes, trying to place the COVID pandemic in historical perspective. What new things did you learn from your research?
Well, the good news, it's not all doom and gloom, is that this is by no means the worst disaster in history or even in the last century or so. The comparison that's often been made is with the 1918-19 Spanish influenza. But in reality, right now, COVID-19 is closer to a much less well-remembered pandemic, the 1957-58 Asian flu. And even if you take the worst case scenario, the kind of maximum possible dead number from a recent economist recalculation of likely excess mortality, it's still an order of magnitude smaller as a proportion of the world's population that has died. I mean, we could conceivably get to 0.17% in a bad scenario, but the Spanish flu killed 10 times that proportion. It was 1.7%, maybe even 2%. So we're actually going through something worse than the Asian flu 57-58, but that was a disaster that quickly faded from memory. The real significance of this disaster is more how we responded and the economic shock that we administered with the measures that we conventionally call lockdowns that most countries had to resort to when they failed to contain the initial spread. And so economically, this is a disaster that looks quite like a world war. If all you knew about the United States today was the federal debt in relation to GDP and the size of the Fed balance sheet, you would say, wow, there must have been World War III. Maybe it began in 2008 and it lasted until 2021. So we're really in the midst of a tremendously dramatic shift in public finances and in monetary policy. And that may be the historically significant thing about this disaster.
Mm-hmm. Right. So you at the end of the book talk a bit about some of the winners and losers, and you talk about how cities are unlikely to be doomed from this catastrophe, which I suppose is good news for all the banks holding commercial real estate debt. Who are in your view, some of the other likely winners and losers coming out of this pandemic?
Well, when I was writing the book last year, and you must remember that a book is not a newspaper, so it kind of stops in October of 2020 when I had to hit send with the corrected proofs. There was a lot of talk about China as the kind of winner of the pandemic, and that the Asian century was now well underway and the US had completely screwed up and it was a disaster. And I didn't buy that then, and I buy it even less now. I think that China has suffered a significant setback, not only in terms of its economy and its demography, but actually in terms of its international standing. A lot of people who previously were giving Xi Jinping the benefit of the doubt have now understood that we are dealing with a totalitarian regime, and that if you watch the movie or the documentary drama Chernobyl, you have a pretty good idea of what happened in Wuhan at the end of 2019. I think the United States than it did when I was finishing the book, and my instincts that the US would win or be one of the winners in the vaccine race turned out to be right. That's important. If you're going to get one thing right in a pandemic, do get vaccination right, get vaccines that work, and then get them into people's arms. Well, we did that. And that turns out in the end to be the most important thing. Most of the countries that did better than us last year are doing a lot worse than us in those terms. I think we have a big challenge, though, in front of us, which is to try and learn the right lessons from this disaster, because it's very tempting to learn a simplified lesson, which is that it was all Donald Trump's fault. We got rid of him, problem solved. In truth, what I think we've learned is that the public health bureaucracies of the Western world failed terribly, despite on paper being well prepared for a pandemic. So if we conclude that it was all Trump's fault and that problem has now gone, we're not going to really learn the right lesson. from this disaster. And that was one reason I wrote the book, because I was pretty convinced that we think about disaster in the wrong way. We always want to blame the man at the top. That's our default setting. It was what happened when the Space Shuttle Challenger blew up. It was what happened when the Titanic sank. So if you actually go back and look at disasters, it tends not to be the person at the top who's really to blame, even if they are inept and say lots of dumb stuff like Trump did. In truth, the point of failure is often further down the bureaucracy. And this is an important thing for us to learn. Dominic Cummings in London made this sort of point a couple of weeks ago in his testimony and his great Twitter thread. We have a problem in Western bureaucracy. We get the illusion of preparedness, but when there is actually a disaster, it goes horribly wrong. And I'm not sure that enough people have yet learned that lesson.
Interesting. There's a number of things you mentioned there we're going to, I think, come back to. I just want to pick up on your comment about the economic disaster and this debate right now about inflation. We have some price data coming in hot, and there's kind of two camps, it seems. You've got the Fed arguing that this is transitory and we shouldn't be too worried about this. And then you have others like Larry Summers who are arguing that, whoa, the Fed's really playing with fire here. Do you have a view on this? Are you more in the Fed or Larry's camp on this? And what are you looking for in particular?
Well, Larry Summers and I go way back. It was Larry who hired me to come teach at Harvard back in 2004, I think it was. And he and I have been in regular communication about this issue. When Larry published his piece in the Washington Post saying we're going to overheat the economy and this could have inflationary consequences, it was in the wake of conversations that we'd had about what the relevant historical analogy was. And I think the relevant analogy is the 1960s. And it's appropriate because Joe Biden's team love to say that he's a transformative president like Lyndon Johnson, forgetting a little bit that Lyndon Johnson didn't exactly end his presidency in a blaze of glory. In addition to the epic fail of Vietnam, the inflation expectations genie went right out of the bottle on Johnson's watch. Prior to his presidency, inflation had been jogging along below 2% in the early 60s. And then in two big jumps under Johnson, it went to 3% and then to 6%. And that was because of a major mistake at the Fed. They were behind the curve, as well as the fiscal expansion associated not only with the Great Society, but with Vietnam. So I think I'm much closer to Larry. And not only because of history, I think also because of economic theory. There is nothing that I know of in literature that says inflation expectations are mean reverting and will simply kind of tend to be anchored. No, on the contrary, the evidence that goes back to Tom Sargent's work, which I remember studying as a graduate student in the 1980s, is clear. Inflation expectations can take off relatively quickly and be very hard to bring back under control. Sargent wrote a famous paper, The Ends of Four Big Inflations. He and I used to joke about how there needed to be a companion paper called The Beginnings of Four Big Inflations. If you did that paper, what you'd find is that unlike ending inflation, which requires a drastic regime change of the sort we got from Paul Volcker, the beginning of an inflation is often imperceptible. If you want to know what I mean, read Alan Meltzer's History of the Fed. I mean, what the Fed did in the 1960s was they didn't go out on the sidewalk saying, regime change, inflation is coming, we want it. On the contrary, they took their eye off the ball, underestimated the inflation risk, and then they were scrambling to keep up. And along came in the 70s, the oil shocks, just to compound matters and drive inflation up to double digits. I think what we're seeing at the moment is a similar mistake, but worse, because the Fed is explicitly saying, we want inflation and we're not worried about it, we're chill. So this is a regime change that's explicitly being signaled by the Fed at the same time as the administration is saying we're transformative. We're transforming fiscal policy. We're going to spend up to $6 trillion on a whole bunch of plans to deal with the economy. That seems to me like exactly how you would unanchor inflation expectations. And I'll be truly surprised if they get away with it. I mean, there's some possibility that they're lucky. I don't have huge confidence. I think there's enormous uncertainty about where we are. a year from now or 2 years from now. But it seems to me that the balance of probability is that Summers is right. There's a significant inflation risk, and or the Fed will have to tighten earlier, and it will have to tighten in a way that leads to a recession, because that's obviously one way that this could play out. The scenario where they get away with it, where they can keep the expansion going and they don't overshoot on inflation, that is the low probability scenario. And it's, for some reason, it's Jay Powell's base case.
So when you think about that regime change, what do you think are the impacts on sort of the global financial system and the US economy specifically if we do go into an inflation regime change?
Well, the first thing to remember is that we are talking about a global and not just a national problem. In truth, the inflationary pressures are much greater elsewhere. China right now is scrambling because the producer price index is showing flashing red lights. And the thing that they worry about there is what happens when the consumer price index starts to flash the red lights. They have some very disagreeable memories in Beijing of what happens if there's an inflation surprise in China. And so you can be sure that they'll be massaging the figures and doing non-market interventions to try to prevent that from happening. Then there are the countries like Brazil that went large in fiscal and monetary policy without being US, without having the US dollar, and they are clearly going to be heading into to the danger zone, and Turkey's in the same category. So there are a bunch of countries that are already, I think, on the watch list. If the US, let's take the two scenarios, Peter. Scenario one, the Fed just does the 1960s, 1970s routine, and it just lets things slip so that we're suddenly talking about 5% inflation. And still they don't tighten because it's all going to be fine. I mean, in that world, I think we have all kinds of memories of the 1970s coming back to haunt us, because if the US is at 5%, then other countries are at 15% suddenly. And don't forget, we're going to add an additional inflation shock on top of that, because all of these new Green New Deals, all of these radical transformations in energy policy are not without their cost, and will undoubtedly, I think, filter through to higher prices, not only in terms of energy, but in other areas. So that's scenario one. We kind of slip from the 60s into a version of the 70s. Scenario two is different, and that is the Fed goes, oh, heck, we made a mistake, terribly sorry, we've got to tighten. And then you have an emerging market debt crisis pretty quickly, because there's a whole bunch of levered players out there, including at home, who would get hit.
Because a lot of our podcast listeners are probably didn't go to grad school in economics. And so when we think about that inflation, in scenario one, how do people sort of see that on a day-to-day basis? And how does it play out in, the equities markets, the FX markets, et cetera?
So in daily life, what happens is that you notice the price rises when you're filling your gas tank in the car, when you go do the grocery shopping. That's kind of where people tend to perceive inflation. And then the central bankers will say, that's all very, very subject to fluctuations and noise, so we tend not to look at those things. And we have our core inflation measure, and that's what you should focus on. And the current arguments that the Fed makes are, well, there's some strange stuff going on in the used car market, so discount that. If you're a central banker, it's very convenient to redefine inflation to exclude the things that are inflationary. Ordinary people are very unresponsive to those arguments. They will care about the cost of filling the tank, and they will care about the cost of filling the refrigerator. So that's where inflation expectations tend to take off. If people are noticing inflation and talking about it, which we know they are, it's because they're encountering it on a regular basis. Then you have to ask the question, well, what do you want to hold in such a scenario? And the naive view is, well, bonds are going to get taken out in this scenario, but don't worry if your portfolio is mostly equities. Sorry, I have bad news. That did not work well in the late 60s and early 1970s. Actually, equity markets got crushed. It's not actually a good environment if you get into inflationary territory for corporate earnings. You can already see the problem in wages, and this is the other thing that you need to look at. How much pressure will there be on wage bills? Right now, although it isn't widely discussed in the media, consumer price inflation is running ahead of wage inflation. As far as we can calculate and compare these things, real wages are actually going down. But there's a lot that suggests to me that that might be temporary, not least the perception that quite a number of people have left the workforce not to return in the course of the last 18 months. So I think that's the next thing to notice, that in fact, stocks may not be, in other words, the discounted flow of future corporate earnings may not be the best protection against inflation. And then you get into a bunch of other things. Real estate. Do I just want to stock up on real estate? That's what a lot of people have been doing. I mean, a lot of people are just like, okay, interest rates are at zero, inflation may be coming. Give me some real estate, and that's of course where you start to see inflation in housing. Not that the Fed counts that in a rational way, but it's there in house price indices for everyone to see. This, I think, from the vantage point of blockchain, is a very interesting moment. Because in practice, the world is entering a potential crisis of the fiat system, and it's not immediately obvious how you can best hedge yourself against that. But one thing's for sure, if at the beginning of the pandemic, you said to yourself, this could get pretty ugly, I need to increase my crypto holdings and rather than my gold holdings, then you really did very well indeed. And that was the right way to play 2020. And it may be the right way to play 2021 and beyond.
Well, let's hope. I think one of the interesting things in the market is like, you have, used car prices up massively, real household goods up, real estate, they literally don't have any inventory left. And we're only a few months into this, and we've got a 6 trillion spending package on the way. And it is kind of hard to imagine how this doesn't, cause some kind of failure in the Western financial system.
Well, the couple of get out of jail cards that the Fed clearly hopes exist are, one, that there's some productivity growth surprise to the upside. And I think that's important to watch. Now, we can only guess. The movements of productivity growth over the decades are one of the great mysteries of economic history. But I think that if you look closely at the Fed's calculations, they imply that there's some productivity growth surprise coming out of our increased use of technology during the pandemic. Maybe working from home makes us more efficient. I don't believe it myself, which is why you find me in an office at the first opportunity. But there's a lot of hope being pinned on that. And then there's the labor market, which is also a little bit of a mystery. Do people come back into the workforce? Is there slack out there? Or did we unwittingly actually kick a whole bunch of people out of the labor force who aren't going to come back in? And those two things, I think, will determine just how much inflation we get over the next year or so. If the Fed is lucky, it gets productivity growth, it gets people coming back into the workforce, and all of what we're seeing at the moment is indeed transitory. I mean, it's not a 0% probability that they pull this off. But as I said, it can't be the base case. There's too much that is signaling, not just in the US, but globally, a significant inflation uptick. And the thing, as I said earlier about inflation expectations, is that once they start to move, it is not easy to bring them back to where they started.
Mm-hmm. Neil, wanted to ask you about the big news this week in crypto out of El Salvador, declaring Bitcoin, the first nation to declare Bitcoin as legal tender. I believe in some US states like Wyoming, gold and silver are still considered legal tendered. So I wanted to get your historical perspective on this designation of Bitcoin as legal tender. How significant is that?
I think it's significant because it points to the importance of crypto generally, and Bitcoin in particular, in Latin America. Remember, if you're somebody who grew up in Latin America, your expectations of inflation are very, very different indeed from your contemporaries who grew up in the United States or Western Europe. You know not only that inflation can go double or even treble digit, you also know that they can change the rules on you, change your currency overnight, confiscate all or part of your bank account. This stuff happens. If you're a Venezuelan, you've watched one of the richest countries in the region turn into a basket case because of the craziness of the Chavez-Maduro regime. And you've seen your savings, if they happen to be in Venezuelan currency, pretty much evaporate. this is why there's huge demand for Bitcoin and other cryptocurrencies in Latin America. And I think this El Salvadorian decision, which got a lot of attention, is really part of a wider trend. There is much more usage and holding of cryptocurrencies in South America than in North America. And I think that is easily explained by the experience that people have had, not only in the course of their lives, but they've heard this from their parents and their grandparents going all the way back into the mid-20th century. And that's exciting, actually, because it means that things are sometimes moving faster in South America and Central America than they are in North America. I mean, I'm involved in a big fintech company that started life in Argentina, Walla. While we're already moving towards having the ability for people to hold Bitcoin and other cryptocurrencies ultimately, because that's what customers want. And we've attracted a very young crowd of people who previously were outside the banking system and are now in it because they can get a wallet account so easily and use their smartphones in order to transact. So I think Latin America is a very interesting place to watch. In some ways, it's moving faster than North America in the direction of the monetary system of the future.
And we've seen a few comments from the IMF, or officials at the IMF and the Bank of International Settlements about this move by El Salvador. They're a bit ambiguous. I think the IMF official said this raises questions. The BIS called it an interesting experiment, slightly more positive, perhaps sounding comment. There's some questions around, is this just a bargaining chip for El Salvador and its negotiations with the IMF, or how, El Salvador is already on the dollar. There's not too many other countries that are like El Salvador out there. Do you think this is something that, the IMF and other institutions will push back on? Is it too small to really worry about this? Or is it something that needs to be, if you're in Washington, D.C., kind of looked at very closely and carefully as you think about the U.S. dollar's role, in El Salvador and around the world going forward?
The great uncertainty that now hangs over cryptocurrency, Bitcoin, centralized finance is what are regulators going to do? And that is the thing that has checked the appreciation of crypto over the past couple of months. And each piece of regulatory news has its impact on the market. We're going to be living with this, I think, for some time, because the regulators don't know what to do. They probably understand that they can't kill this new ecosystem. It's way too late for that. If you wanted to strangle Bitcoin at birth, you needed to do it prior to, let's say, 2011, 2012. You had to do it early. It's now too big to kill. You also have already taken some decisions that essentially tax the holders of Bitcoin and other cryptocurrencies. You just you're happy to take their money from capital gains or income, depending on how you want to, but you're taxing this stuff. So you've granted it that legitimacy. But what's fascinating to me is that regulators around the world are making it up as they go along. They cannot quite decide what it is that they want to do. How far do they want to restrict it? Do they want to actually take advantage of its success by collecting taxes? Or are they terrified that it's somehow going to erode the state's monopoly on money? And that means that we're going to be stuck with regulatory uncertainty until, frankly, the regulators and the economists who advise them understand this phenomenon better. Part of what drives me nuts is that this is not something that the typical conventionally trained economist who goes to work at the BIS or the IMF understands very well. And you only need to read what the great economists of the world have written over the last 10 years about crypto to see why. It's very hard to think of any of them who haven't made fools of themselves in their commentary. And they continue to make fools of themselves because they fundamentally don't understand the financial revolution that is underway. So that's our problem. I don't think it's going to go away. I wish I could tell you where we land. But ultimately, where we land in terms of regulation is a function of how quickly the economics profession upgrades its understanding of crypto.
Yeah, I would love to go deeper into that, talk about, is there something in the DNA of macroeconomics that explains why so many of these great economists have just struggled and continue to struggle, as you mentioned, to grok this? I won't name any names. We know who we're talking about here, but
I think it's lack of historical perspective. Garrick, it's lack of, the problem is that because economists don't really like economic history, it's a lot of work and you can't do so much math, because basically economic history has been downgraded as a discipline in all economics departments and killed off in history departments. People aren't well attuned to how financial and monetary revolutions happen. But if you've studied, for example, the evolution of the earliest equity markets in the 18th century, then you know that when an innovation comes along, there's an experimental phase, and that's commonly associated with bubbles before the use case is stabilized and the bubble phase ends. My own recent research has focused on the resemblances between the market for bills of exchange and the evolution of blockchain-based assets and quasi money. And it's actually a great analogy, because bills of exchange evolved as a means of financing trade precisely because the existing coinage systems of the 16th and 17th century were so dysfunctional. You couldn't actually do trade finance with coins. So what do? You have a network-based system of bills of exchange that are verified through the network by means of signatures. It's a brilliant innovation. It propels the globalization of trade, becomes central to the financial system by the 19th century, and has nothing to do with the state. So if any economist in the world has really studied that history, then they would be much less surprised by the way in which crypto has evolved, because this is financial evolution in real time. I wrote about this in The Ascent of Money before crypto, because it was written even before Satoshi's paper was published. And I made the point that financial history is an evolutionary story, and there are periods, Cambrian explosion-like periods, when lots of new things suddenly come into existence, just as there are periods like the financial crisis when a lot of institutions go extinct. But that's what economists tend not to study, and they tend not to teach their students. For many decades, economics has abstracted itself from history, and it has also, by and large, ignored money and finance in order to make the models for growth manageable mathematically. And that is why they're clueless when they're confronted by a new wave of monetary and financial innovation.
I think one of the things, that you told me in your office a couple of years ago that I found really interesting and almost embarrassing, because I went to graduate school for econ and, run a crypto company, is we were talking, I was asking you about your view on cryptocurrencies, and I was like, this must be really shocking, because a whole new monetary system out of thin air. And you were like, it's not shocking at all. People have been inventing new monies every 50 to 80 years since people invented money. And I had really never realized that, and sort of sent me down a rabbit hole of researching, how long has any given money been alive? And particularly when you factor in, like, when the dollar fundamentally changed after the gold standard, most of our currencies today are very young relative to the arc of human economic history. And they are continually being replaced. Like, we're not all trading in, Roman coins. Exactly.
Right. Fiat money is 50 years old. It's 50 years ago that Nixon broke the link from gold to the dollar. And that is a short time in the great scheme of financial history, which goes back, 4,000 years, if you want to really go right back to the beginnings of money in Mesopotamia. We don't, I think, realize how recent our existing system is, nor do we realize how out of date it is. A 1970s system, SWIFT being another 1970s innovation, credit cards, pretty much a 1970s innovation. All of this stuff worked pretty well for most of the last half century, most of my life. It doesn't work very well anymore. It's actually a really quite crappy system that takes a long time to make payments happen. It is a system that has created rent-seeking entities called banks that use regulation to build walls to exclude competition. And I think when Darrell Duffy testified just the other day, my colleague here at Stanford, in Congress on this question, the point he made was that we need the innovations, whether it's crypto or central bank digital currency, to force the existing financial system to up its game, Because right now, the incumbents of the fiat money system, which are the big banks, do a terrible job. They're really quite bad at getting the money that we want to send from A to B. And they also collect egregious rents from the transactions they process and the services they provide. And that's another part of the story that I don't think we did discuss back when we first met, that monetary systems not only come into existence at quite high frequency historically, but they also kind of go off. They kind of pass their sell-by date because technology overtakes them. And it's kind of bizarre that we still use SWIFT for interbank transactions. I mean, it's great from the point of view of the US government because it gives it the superpower of financial sanctions. But there's no obvious reason why 50 years from now, we'll still be doing international transactions via SWIFT. In fact, I'll bet you 100 Bitcoin we won't be.
Neil, I just want to come back to this lack of grand strategy on the part of policymakers and regulators around crypto, and come back to China, where you've, I know, spent a lot of time and have done a lot of great work. There's a great 3-part series you did a number of years ago on China. I highly recommend people check that out for a historical perspective on China. And I remember back in your Boston office in 2015, talking about how China could leverage maybe Bitcoin to gain some strategic financial advantage in its quest to catch up with the US and overtake it as a leading financial superpower. And we're seeing this latest crackdown from China maybe having a bit more teeth than past ones. And I'm just wondering, does China have a grand strategy? Are they blowing an opportunity here by trying to crack down on things like Bitcoin, or are decentralized networks like Bitcoin just fundamentally incompatible with the hierarchical approach in China, and this has to be driven offshore and elsewhere?
Well, I remember thinking with a smile, I've heard this before, when Peter Thiel earlier this year startled people by saying that Bitcoin was China's secret weapon in its challenge to the dollar. Sounded like a classic Thiel contrarian line when he said that. But as you just mentioned, I'd been pondering that possibility for a while. Clearly, the Chinese allowed mining to flourish, Bitcoin mining to flourish in China, but they were nervous about allowing Bitcoin to be used by Chinese citizens for transactions, or even as a store of value or a speculative object. They do have a grand strategy. I don't think Bitcoin is a part of it. I think that they're ultimately going to shut Bitcoin mining down, and I think they are ultimately intending to drive it out of the Chinese system altogether, because it's not part of the strategy. The strategy is central bank digital currency. The strategy, which has been accelerated by the pandemic. I mean, back in 2019, this was not ready for prime time. I know, because I spoke to People's Bank of China officials in late 2019, and they made it pretty clear that things were still on the drawing board. But the pandemic created an opportunity that the Chinese Communist Party seized to roll out this not quite ready central bank digital currency. Why? Number one, to constrain the increasingly dominant role of the big tech companies in China itself, because ultimately the payment platforms created by Alibaba and Tencent were getting too powerful. I think the priority nearly always in China is domestic, and central bank digital currency is primarily about restoring the power of the state-owned banks and ensuring that the People's Bank of China has direct surveillance over all transactions at will, rather than having to ask Jack Ma if you can have a look at the Alipay data. So that's the main point. The subordinate part of the strategy is to try to expand China's role in international payments. If you can get the central bank digital currency, the yuan or ECNY, to be adopted by a significant number of China's trading partners and to be used for cross-border transactions, then you start to pose a meaningful challenge to the dollar. Remember, the yuan is already being used in a lot of intra-Asian trade. It may not signify in central bank reserves or in global trade, but it's growing in Asian trade. And I think the Chinese objective, and it's strategically smart, is to make their currency a more and more attractive payment rail for cross-border transactions. And that should worry the US a lot, because the key to American power is the dollar's dominance of trade, and particularly of cross-border payments. That's why financial sanctions are the superpower, because you really can't do much in the way of international payments if you're not on SWIFT. If the Chinese create an alternative payments architecture that doesn't require the US's approval, then a fundamental hole has been blown in US financial and monetary dominance. But I don't think that's the primary objective of Chinese strategy. I think the primary objective is actually domestic. If their ultimate objective had been global dominance in payments, they would not have killed the Ant Group IPO the way they did.
And you mentioned the U.S. dollar, and I think this is a good place to turn now as we kind of come to the end of this podcast. You know, a lot of interest in central bank digital currencies. Not just in the U.S. and China, around the world. What's your view on how these are going to be designed in various places? I mean, it looks like obviously China's going with a highly centralized approach with their DCEP. Do you think in the U.S. and Western countries we're going to see something that's more centralized than like what Chairman Giancarlo and others are proposing, which is more private sector led, maybe a bearer instrument like cash is today? Where do you think this is going to wind up from a design perspective in the U.S. and elsewhere?
Well, I wrote a piece a few weeks back saying, let's not make the mistake that we've sometimes made in the past in our strategic competitions, the mistake of copying the enemy, because it's not really a victory if you end up becoming like a totalitarian adversary. This is a point Norman Mailer makes in The Naked and the Dead, but it's actually a Cold War point too. The United States always ran the risk of becoming a little bit too like the Soviet Union because of the exigencies of Cold War. So when I hear people say, the Chinese have a central bank digital currency, we need one too, I'm extremely skeptical. I mean, my view is that it would be a grave mistake to copy and paste a Chinese model, especially one that is still at its fledgling stage, but also more importantly, to copy something that so obviously aims at central surveillance of all transactions cannot be in the interests of a free society. We already have too much surveillance of the legal transactions of private citizens in the United States. It arose out of 9/11 and the rules on financing of terrorism, and then the rules against money laundering and organized crime. But we're now in a situation where we already have excessive surveillance of individual legal transactions, rather than regarding it as an exception that is necessary in cases of criminality. So I think we need to think completely differently about this from the Chinese. A virtue of our system, the reason it's worth resisting Chinese dominance is precisely that it values individual liberty, and privacy is a part of liberty. It's not desirable for the state to have excessive powers of surveillance over the citizens' lives. And the beauty of blockchain-based technologies is precisely that they can reduce the power of any central authority. So I think we need to approach the monetary revolution in a completely different spirit. We need to say already the United States has been innovative, not only with Bitcoin, but also with decentralized finance. We have an exciting ecosystem that extends through exchanges, wallets, a whole variety of different institutions. And the great and appreciable benefit is the decentralization and competition that are the hallmarks of the American way. So my view is really we should be building on crypto, integrating it into our system, rather than trying to build some made in China version of central bank digital currency. The challenge is to persuade the people in Washington that there's a way that they can live with Bitcoin, a way that they can live with crypto and decentralized finance, because they fear losing the exorbitant privilege, not only of dollar dominance in international trade, but the exorbitant privilege that gives them the right to surprise the holders of fiat with the inflation tax whenever they feel like running multi-trillion-dollar deficits. So this is the challenge, and I'm not sure it's going to be an easy fight to win. The most important thing, in my view, is that we should not throw away the gains that we've already made over 12 or so years of monetary innovation, and not allow regulators who are short-sighted or self-interested to kill what is the goose laying multiple golden eggs. The US is evolving a system of decentralized finance in real time. It's an extremely exciting thing to watch. Many parts of the Western world want to be part of that, not only Latin America, but also Europe. This is a very exciting alternative to what the Chinese are trying to build in East Asia. The last thing we want to do is kill it off and copy them.
Yeah, I mean, that's maybe a good final note to end on there. Peter, anything else for Neil before we let him go?
No, I just want to say thank you for coming on the podcast and, coming at things with a historical perspective for us tech folks who, our memory only goes back about 6 months at any given time.
Well, it's been a pleasure to talk to you, gentlemen. I've learned a lot from you over the years, going back to when Garrick and I first met at the London School of Economics. Garrick, you're doing terrific work to give us a kind of historically informed understanding of where Bitcoin and crypto are going. And Peter, you're one of the pioneers in this field. It's going to be, I suspect, fascinating time as we grapple with the unexpected regulatory challenges that doubtless lie ahead. But I remain confident, as I've been really since I revised the Ascent of Money for its 10th anniversary in 2018, that crypto and blockchain are here to stay. And those Cassandras in the economics profession who predict the doom of crypto and the death of Bitcoin will continue to be proved as wrong as they have been since they started making those predictions.
Great. Well, thank you, Neil, so much for joining. It's been a pleasure, and we wish you the best always.
Thanks very much indeed.